Welcome to the Deep Dive. We are kicking off today with what feels like one of those compelling and maybe bizarre cross-disciplinary comparisons we have ever tackled.
It really is.
We're talking about professional baseball and high-stakes financial trading.
Yeah, on the surface, it sounds like a total non sequitur, doesn't it? I mean, one involves grass and bats and, athletic performance. The other is algorithms and screens and milliseconds.
Exactly. What could the owner of a billion-dollar baseball franchise possibly have in common with a quant hedge fund manager who's betting on global market volatility?
Well, you'd think nothing. But the power of this comparison, and this is why we're so excited about this, is that both of these fields, baseball and finance, they've gone through the exact same devastating intellectual revolution.
Devastating is a strong word.
It is, because it devastated the old way of thinking. It was a complete replacement of subjective human intuition, of gut feeling, of emotional bias, with cold, hard, systematic data.
Okay, so let's unpack this revolutionary idea. We've been diving deep into sources that explore how this systematic thinking, this deliberate and rigorous replacement of gut feeling with data, is the non-negotiable key to success.
Yes.
Especially in these arenas that were for so long defined by ego, by personality, and by that mythical eye for talent.
Precisely. And our sources really pull back the curtain on two incredibly powerful intellectual shifts. In sports, you have the statistical takeover of baseball. Most people know it as Moneyball.
Sabermetrics.
And then in finance, you have the rise of behavioral insights that explain with clinical precision why human intuition repeatedly fails in volatile markets. And this failure is what justifies the rise of things like trend following and other systematic strategies.
So our mission today, then, is to uncover that shared system.
That's it. The common, dispassionate system that conquers subjective bias in both of these arenas. The system that delivers this enormous, almost unfair, asymmetrical advantage to anyone willing to just embrace the math and, kill their darlings.
And this dive is so relevant to you, the listener, because it's really about cultivating a generalist mindset. It's about learning to see the web of connections between fields you thought were totally unrelated. And realizing that the most powerful tools for thinking outside the box often involve, kind of ironically, relying on simple, rigorous numbers inside the box.
Whether that's the batting box or the trading box, it's the same logic.
Exactly. So let's start with baseball. Let's start with the story of how data completely took over the American pastime. Because for, over a century, baseball was ruled by tradition.
Oh, completely. It was a closed loop. Scouts, who were almost always former players themselves, would rely on what they called the 5 tools and just their gut feeling to judge talent. It was entirely subjective.
And that subjectivity, that's the crack in the armor, isn't it? That's what's ripe for exploitation.
That is the market inefficiency right there. And we need to introduce the central figure here, John W. Henry, the owner of the Boston Red Sox. Before he ever bought a baseball team, Henry was a massively successful pioneer of systematic trend following in the financial markets. And what he did was he essentially applied the basic tenets of his trading philosophy.
The exact same one.
The exact same one. Simple heuristics, mathematics, statistics, and just this dispassionate system application. He took that rule book from Wall Street and walked it right into the dugout.
That sounds dangerously simplistic. I mean, he must have faced immediate fierce resistance from the traditionalists, right? The guys who've been in the game for 50 years who say you can't treat a human being like a bond portfolio.
Oh, the pushback was immense, but his financial background gave him this clarity to see the common flaw. And this is the critical point Henry noted. People in baseball and people in financial markets, they operate primarily with these deeply ingrained, almost religious beliefs and biases.
Give me an example.
A scout believes a player has to look a certain way. He has to look like an athlete. A stock picker believes a company must succeed because, they love the product or they admire the CEO.
It's an emotional attachment.
It's pure emotion. And Henry understood that the clear advantage goes not just to the person with more information, but to the person who can eliminate both the beliefs and the biases and replace them entirely with objective, measured data.
So he really did view the team as
all of it. Bean used data to determine the cold odds of success. They literally calculated the actuarial likelihood of that high school pitcher ever making it to the major leagues, regardless of how great he looked on a single day. And this reliance, it shifted the whole focus from subjective potential to what they called sabermetric truths.
Which were, to be specific, just measurable production factors. They focused intensely on skills that the old guard just didn't value as much.
Right, things like drawing walks.
Which is not sexy at all.
Not at all. But it means getting on base. And that's what produces runs. So drawing walks, hitting home runs, overall disciplined plate discipline. These were quantifiable skills that translated directly into winning games. And because the old scouts didn't value them, they were market priced too cheaply.
So it's the classic arbitrage opportunity.
It's the difference between style and substance. If you can't measure it, you can't manage it, and you certainly can't value it correctly. The statistical takeover happened because it exposed the inherent subjectivity and the mispricing that subjectivity creates by relying on emotional judgment. It's just the quantification of what actually matters to win.
So let's define this concept precisely then. What exactly is sabermetrics beyond just, using stats?
Well, the core definition is that it's a dispassionate statistical investigation. Its entire purpose, its reason for being, is to challenge perceptions that are often misguided by emotional bias or by anecdote or just by tradition. This is how we've always done it.
It's the application of the scientific method to sports performance.
A systematic way to calculate expected value. That's a great way to put it.
And the intellectual roots of this whole movement, they go way back, right? Back to figures like Bill James, who was essentially doing this analysis out of his garage decades before Billy Beane made it famous.
Absolutely. And James's insight was so profound. He contrasted traditional sports reporting and scouting, which he saw as basically just selecting evidence to force a conclusion you already wanted to prove.
Confirmation bias, basically.
100%. He contrasted that with the sabermetrics approach, which is an open-ended search for answers and explanations. You let the data drive the conclusion, even if that conclusion is painful or, completely counterintuitive. In a world dominated by personality and narrative, that methodological difference it's just revolutionary.
This is the exact battleground where the source material introduces this fantastic term, the Adonis bias.
I love that term.
It's so good. It's the conflict between the ideal image of a player and his actual measurable output.
It's a perfect contrast. The old guard of baseball scouting, they loved the Adonis athlete. The guy who looks the part, he's got the build, he's marketable, you can imagine him on a billboard. Maybe someone like a Tim Tebow in football.
He looks like he was built in a lab to be an athlete.
Exactly. But sabermetrics demanded that you ignore the look. You have to. You must focus on pure objective production, even if the player doesn't fit that mold at all.
And the example used is David Ortiz, Big Pappy, the iconic Red Sox hitter.
A perfect example. Hall of Fame statistics, an absolute legend, but famously, he had a less than chiseled physique.
A healthy midsection, I think the source called it.
Right. But the statistics were undeniable. The numbers were Hall of Fame level, even if the visual impression didn't match the scout's traditional ideal.
So Henry's lesson from finance applied directly.
Directly. People in all fields operate with biases that prevent them from seeing the truth of performance. But if you can replace that subjective evaluation of an athlete's look with the objective data of his on-base percentage, you gain an insurmountable edge over your competition. It's that simple.
It seems like statistical literacy, or at least a passion for it, is just.
Yeah.
It's the underlying prerequisite for success in these systematic fields.
It is absolutely essential, and the source makes this so clear with a couple of really powerful quotes. There's Paul Fisher's observation that a passion for statistics is the earmark of illiterate people.
That's a strong statement.
It is. But more fundamentally, Steven Pinker highlights the critical cognitive vulnerability for both the scout and the discretionary trader. The unaided human mind is desperately, desperately vulnerable to fallacies and illusions.
Why is that? What's the core reason?
It's our evolutionary wiring. Our brains are designed to rely on vivid anecdotes, the dramatic story of the star player making a diving catch, or the one successful stock pick you get to brag about at a cocktail party.
The story you tell yourself and others?
Exactly. We remember that dramatic story because it's emotionally salient. But the system, the computer, it remembers the thousands of daily averages that actually determine long-term success. The unaided brain is designed to filter out the noise, but in a systematic environment, all that boring noise is the signal.
This statistical perspective then leads to this almost existential truth that flawlessly bridges baseball and trend following. And it's the philosophy embodied by Babe Ruth.
Yeah, the great Bambino. He's famous, rightly, for the home run. But the data-driven view, the sabermetric view, reminds us he was also famous for something else.
Striking out. Lot.
striking out frequently. He was the king of the strikeout for a long time.
And even with his incredible lifetime batting average of .342, which is just astronomical, from a pure swing-by-swing perspective, he saw failure far more often than he saw success.
He was willing to fail small and to fail repeatedly in the pursuit of that one massive success.
And this is the core philosophical mandate. Ruth summarized his entire approach to failure and really to life with that perfect quote. Every strike brings me closer to the next home run.
It's so good. He understood that big winners must pay for small losers. It's a non-negotiable cost of doing business.
So let's connect this explicitly to trend following. Let's draw that line clearly. Why is accepting the strikeout mandatory for that trading philosophy?
Because the market doesn't trend very often. That's the dirty secret. Most of the time, prices just fluctuate aimlessly. They chop back and forth, creating noise. So a systematic trend follower has to use tight stop losses.
And those are the strikes.
Those are the strikes. They are there to protect your capital during those non-trending, choppy periods. If the system signals an entry, you get in. But if the trend doesn't materialize, the system forces an exit for a small, predefined loss. And this happens again and again and again.
So you might lose money on 60, maybe even 70% of your trades?
Oh, absolutely. The strikeout percentage is high. A lot of people can't stomach that psychologically. But here's the mechanism for the asymmetric gains. The system keeps you in the market during that 30% of the time when a real enormous trend develops.
Like oil moving from $50 to $100, or a currency pair collapsing.
Exactly. And while the losses, the strikeouts, are systematically capped at, say, 2% of your capital, the profit on the winning trades is uncapped. It can run. So that single home run must generate enough profit, maybe 20%, 30%, or even more, to cover all the accumulated losses from the previous 70 strikes and still leave a significant net gain.
And John W. Henry himself, he recognized that his own multi-decade trading performance followed this exact pattern.
He confirmed it. He said his performance was philosophically closer to Ruth's high-risk, high-reward, high-failure rate strategy than it was to the consistently safe average hitter, the guy who, rarely strikes out but also never hits a world-changing home run.
That's the whole crux of it, then.
It is. Systematic thinking helps you strictly manage the risk of failure, all those numerous, small, predictable losses, so that you can remain liquid and stay in the game long enough to capture the enormous, career-making, asymmetric gains when a massive trend finally decides to show up.
You have to accept that your winners are few and far between.
But they must be gargantuan enough to justify the entire enterprise. So the lesson from the diamond is profoundly simple. If you're not willing to accept repeated, small failure, you are philosophically barred from ever achieving true asymmetric success.
That brings us perfectly from the systematic acceptance of failure to the absolute human refusal of it.
Yeah.
So we've established that data and systems, they win on the baseball field.
Right.
Now, let's transition to the high-stakes trading floor and ask the big question. Why are these cold, calculating, emotionally detached systems necessary in finance at all? Why can't smart people just manage themselves?
Because the market is defined by irrationality. It's that simple. The efficient market hypothesis, the idea that prices immediately reflect all available information, it's a beautiful academic ideal.
But it's not reality.
It's not reality. In practice, markets are deeply inefficient precisely because humans, with all their cognitive flaws, run them. And this systemic inefficiency is what provides the profit opportunity for the disciplined, systematic player.
And thankfully, the academic world has given us this magnificent taxonomy of exactly how we're irrational thanks to the field of behavioral economics.
Exactly. The human actions that drive the infamous booms and busts, you can go back to the 17th century Dutch tulip mania, the dot-com bubble, the housing crisis of 2008. They are all best described by a specific, predictable list of cognitive biases.
We're talking about things like prospect theory.
Prospect theory, cognitive dissonance, loss aversion, and then all the assorted heuristics we use for rapid-fire judgment and decision-making.
Let's focus on prospect theory for a minute because it feels so fundamental to understanding why markets fail, or at least why humans fail in markets.
It's the bedrock. Prospect theory, which was primarily developed by Kahneman and Tversky, describes how humans value gains and losses differently. The key finding, the one that changes everything, is that the pain associated with a loss is felt roughly twice as powerfully as the pleasure derived from an equivalent gain.
That asymmetry is huge.
It dictates everything. So if I gain $1,000, I feel good. But if I lose $1,000, I feel terrible.
Yeah.
In fact, I feel twice as terrible as the good feeling I got from the gain.
And that reality fuels loss aversion.
That's the behavior that comes out of it. Because the pain of loss is so powerful, investors are often willing to take far greater risks to avoid realizing a loss than they would ever be willing to take to achieve an equivalent gain.
So they hold on.
They refuse to sell a losing asset. They'll hold on, praying it will return to break even, just so they can avoid that painful psychological moment of admitting failure.
And the history books are just overflowing with evidence that these biases are, they seem eternal. They seem immune to education.
Look at the sheer predictability of manias. The evidence across centuries proves that investors, and I'm quoting here, can't and will never steer clear of manias. They repeatedly make the same mistakes because the irrationality is hardwired into our brains.
And it's driven by these mental shortcuts, these heuristics.
Right, like the representativeness heuristic. This causes investors to believe that past success guarantees future success. So if a bubble is rising, they ignore all logical warnings because the recent vivid examples of their neighbors making money confirms their optimistic belief. It's a deeply flawed mental shortcut.
So let's drill down into what seems like the most common and destructive flaw in trading, which is that combination of loss aversion and the sunk cost fallacy. You can just picture that common investor archetype who refuses to sell.
Oh, we all know this person, or maybe we've been this person. This is the trader whose ego has become completely entangled with the trade. They refuse to sell a stock even when all the fundamentals, all the signals indicate it's collapsing.
Why?
Purely because they made the initial decision to buy it. They cling to the belief, I am right, the market just hasn't seen the genius of my pick yet. And they rationalize holding on to the loser by telling themselves they're buying on a discount, even as the stock price is signaling the complete implosion of their original theory.
So they transform what should have been a small, manageable strikeout into a massive portfolio-destroying failure.
Exactly. They refuse to pull the knife out of their foot, to use that classic analogy. And this is where systematic trend following provides its pièce de résistance. It's that explicit, non-negotiable instruction. Take your small loss and go home.
The system forces the action.
It forces you to accept small losses automatically. Discretionary players, though, they remain ambivalent towards sunk costs. They refuse to take that initial small loss. And that refusal is precisely what enables colossal drawdowns, because they prioritize validating their past decision over preserving their present capital.
This suggests that for a lot of people, the goal isn't actually profit. It's psychological validation.
It is entirely about the ego, and this is such a profound insight from the sources. Many people, whether consciously or subconsciously, they don't actually want financial success as much as they want to be absolutely right, regardless of the financial cost.
The need to be right is stronger than the need to be rich.
For many, yes. If they think they are right, they suspend all disbelief, all risk management, often to the point of tragedy. Just think of the internal mindset of the investors who clung to Enron's stock all the way down to zero. They were so blinded by their need to be right about the company's genius that they had no system, no strategy whatsoever to sell.
And the biological toll of this clinging, of this stress, is enormous, which then further impairs your decision-making. The sources bring in the work of neuroscientist Robert Sapolsky here to illustrate the danger of our own imagination.
Sapolsky's work is fascinating. He noted this critical difference between humans and other animals when it comes to stress. For an animal in the wild, stress is typically short-lived. It's 3 minutes of screaming terror while you're escaping a lion, and then it's over.
The threat is gone, the stress response shuts off.
Right. But the human capacity for imagination means we can turn on the exact same physiological stress response, the fight-or-flight hormones, the cortisol, simply by imagining a stressful situation, like watching a market dip or just contemplating a potential financial loss.
So a trader sitting at a desk, just looking at a screen, is cycling through the same stress responses as a zebra fleeing a lion.
Precisely. And that imagination-induced stress response actively inhibits clear, rational decision-making. It prioritizes emotional self-protection over objective analysis. The trader gets trapped in this state of either emotional paralysis or just manic reactivity, unable to execute the very rules that they know intellectually are the right thing to do.
And this psychological battle, this war between knowing what's right and doing what feels comfortable, is just perfectly encapsulated in the famous Ed Seykota knife story. We have to recount this classic anecdote.
It's the ultimate trading parable. It says everything. The legendary trader Ed Seykota was having dinner with a fundamentalist trader, so someone who relies on company value and news, not on price movement.
Okay.
And during the dinner, Seykota accidentally knocked a sharp knife off the table. The knife twirls through the air and lands point down, sticking right into the fundamentalist's shoe.
Oh my gosh. And what did the fundamentalist trader do?
Nothing. He looked down at the knife in his shoe, and he refused to react. He waited instead for a fundamental reason to pull it out. He needed a news story, a company press release, some external intellectual justification before he would respond to the objective, painful reality of the knife in his foot.
That is the most visceral demonstration of cognitive dissonance I have ever heard. It is painful just to visualize it.
That's the power of the story. Cognitive dissonance is that severe psychological discomfort you feel when you hold two conflicting beliefs at the same time. The trader believes, I am smart, I did my research, this is a good investment. But the objective, painful reality is, I am losing money, and this stock is actively hurting me.
So to resolve that discomfort,
Instead of changing the belief, which requires the ego to admit failure, they actively ignore the objective reality. They wait for an external justification to act.
So in trading terms, this translates directly to a trader looking at a 50% loss on a stock. Intellectually, they know they should sell, preserve what's left. Emotionally, they just cannot process the internal conflict of admitting they were wrong.
And so they invent narratives. They tell themselves, the market is wrong, or, oh, I'm a long-term investor now, or I'm just waiting for the next catalyst. They wait for the market to validate their past decision rather than accepting the present truth. And that inaction, driven by ego and dissonance, turns small problems into catastrophic disasters.
Which is why the systematic approach is so powerful. It forces the action.
It removes the human from the decision loop entirely. It's designed specifically to circumvent this primal destructive flaw.
So the math of systematic trend following is actually pretty simple. Buy high, sell higher, cut your losses quickly. But the execution is brutally difficult because of that human element we just detailed. So if the math is easy, this next part is all about the psychological solution, the mindset that's necessary to actually adhere to the system when every fiber of your being is screaming at you to do something else.
This is where we really move past technical analysis and into pure emotional intelligence. Charles Faulkner, who studied elite traders, he noted that one of the most critical factors for success is self-separation.
Self-separation, what does that mean?
Successful traders separate their personal identity from their trading outcome.
How does that separation manifest in practice? How do you do that?
Well, it's often subtle. It can start with your language. They'll use phrases like, I'm in the trading business, or I work as a trader, rather than that very identity-based declaration, I am a trader.
That's a tiny distinction, but it sounds huge psychologically.
It's massive because if you internalize your losses as a reflection of who you are as a person, the psychological stress becomes unbearable, and that's when the dissonance kicks in. But if you're just running a business, a loss is just a cost of doing business. It's a necessary expense on the path to profit.
But they are still human. I mean, they must still feel anxiety when a trade goes against them, or euphoria when they hit a big winner. They can't just be emotionless robots.
They are absolutely not robots. That's a huge misconception. Successful traders feel moods and emotional impulses just like everyone else. The key is that they learn to recognize them, to control them, and to channel those impulses in useful ways. They understand the fundamental paradox of trading.
Which is?
That what feels good, like taking a small profit early to get that little hit of validation or refusing to take a loss to protect your ego, is often the absolute wrong thing to do for your long-term expected value. They've internalized that success requires behavioral counterintuition.
This is why the legendary systematic trader Ed Seykota focuses so heavily on psychological issues, right? He created what he calls the trading tribe. He seems to treat psychological blockages as the primary obstacle to success.
He does, and his methods are fascinatingly unconventional. They really blend psychological therapy with trading discipline. Seykota and his tribe work on the underlying psychological issues that prevent a person from following their own sound system.
So the question isn't, is my system wrong? It's, why can't I follow my system?
That's it exactly. If the system is logically sound, why do you constantly sabotage yourself? They tackle that question head on. Why do I always reverse my rules when I'm under pressure?
And they use specific techniques to address these subconscious issues, right? I read about breathing exercises, achieving altered states of consciousness. It sounds a bit out there.
It does, but the goal is very practical. The goal is to relax the conscious filters, the analytical, ego-driven part of the brain that's always interfering, to get in touch with the subconscious emotional processes. By working through that underlying emotional charge, the fear of loss, the need for validation, they attempt to clear the path for objective, system-based decision-making. They believe the system is sound, so the failure must be in the operator's mind.
This pursuit of self-awareness even extends to what Psychotis sometimes describes as an intuitive edge.
It's a beautiful illustration of bypassing the overly rational brain. Psychotis shared the story where he'll look at a market and everyone else believes it has completely exhausted its uptrend.
The consensus is that it's over.
It's over. And that, counterintuitively, is precisely when he likes to get in. And when asked how he makes this subtle determination, he sometimes describes techniques like putting the chart on the other side of the room.
To get some distance.
Literally. That physical distance allows the subconscious, pattern-recognizing filters in his brain to operate without the immediate interference of the conscious, fearful, analytical brain, which might be contaminated by the common narrative or the media hype.
This focus on emotional makeup rather than just pure intellect, it leads to one of the most famous counterintuitive findings in quantitative trading, the PhD myth.
William Eckhart, who co-founded the famous Turtles program, where they trained a group of novice traders to run these complex strategies, he observed firsthand that high intelligence, or having a PhD, it did not correlate strongly with trading success.
So you don't have to be a genius.
Average intelligence is more than sufficient to grasp math. What's far more important is your emotional makeup, your discipline, and your commitment.
The market simply does not care about your resume or how many complex equations you can solve.
It doesn't. And we saw the catastrophic failure of the best and brightest, the Ivy League MBAs, the PhD physicists from places like long-term capital management, during crises like 2008. Their intellectual arrogance often prevented them from believing the market could truly be that irrational or that their complex models could fail so spectacularly.
Which is why some firms jokingly prefer to hire traders with what they call the PSD degree.
The PSD degree. Poor, smart, and a deep desire to be rich. That combination of raw ambition and street smarts often outperforms the purely academic intellect, because the PSD trader has less ego invested in being right and more skin in the game when it comes to being profitable.
So the ultimate quality underpinning success, then, it seems to be this combination of discipline and just a raw, open-ended curiosity.
Yeah, absolutely. Commitment means maintaining open-ended curiosity. And this requires you to be intellectually fearless. You have to be willing to step back and see the market for exactly what it is right now without the filter of your past beliefs or your future fears. You have to be willing to integrate legitimate information, even if that information proves your deeply held beliefs are dead wrong.
Which is the operational opposite of cognitive dissonance. You have to prioritize the truth of the market over the comfort of your own ego.
And that takes profound commitment and emotional fortitude. Trend following requires the willingness to ride out inevitable and sometimes very severe drawdowns. You have to accept them as the necessary cost of doing business.
It's not an easy ride.
Not at all. It also requires the commitment to endure long periods of boredom and inactivity while you're just waiting for the next major trend to establish itself. The system requires profound patience to wait for those home runs. And if you aren't willing to do that heavy lifting, to accept the volatility, the tedium, and the repeated small failures, the strategy, no matter how mathematically sound it is simply not for you.
The failure of the system, in other words, is always the failure of the person who's operating it. We started today with this peculiar pairing of professional baseball and financial markets. We moved from analyzing slugging percentage on the diamond through the behavioral economics of prospect theory, and finally deep inside the psychological machinery of the human mind.
It's been quite a journey.
But the common thread, the thing uniting these two seemingly disparate worlds, is the power of dispassionate systematic approaches, sabermetrics in sports, trend following in finance, to overcome the deep-seated emotional flaws and cognitive biases that sabotage human performance.
And the overarching lesson from both of those fields is that complexity is not the answer. Simple, objective approaches, like just following pure price movement in markets or focusing solely on pure production metrics in baseball, are often demonstrably better than complex discretionary analysis.
Why?
Because they fundamentally remove the flawed human element and its infinite capacity for self-deception.
So success, then, is less about achieving these brilliant, perfect predictions of the future, and it's far more about meticulously managing your risk, accepting short-term failures as just necessary costs of doing business.
And remaining absolutely committed to a proven, systematic process that delivers those few but massive long-term asymmetric gains.
The market doesn't reward you for being the smartest person in the room.
Not at all. It rewards you for being the most disciplined and systematic person in the room, the one who's capable of enduring the losses and just waiting for the home runs.
That leaves us with one final provocative thought for you to consider as you go about your day. Think about this concept from the sources, that over-familiarization with something, an idea, say, or a method or an object, is a trap. So in what area of your life or your work, perhaps in a place where you are considered an expert, might your highly prized, nuanced intuition actually be less effective and more biased than a simple, rule-based, dispassionate system? What could you quantify right now to force a more objective truth?
Welcome back to the deep dive. You know, our whole mission here is to take some really dense, complex material.
The kind you'd normally need a week in a quiet room for.
Exactly. And to distill it, to break it down into something you, the listener, can actually use. Today, we're really getting into the foundation of success.
We are. We're looking at how we manage uncertainty, how we make choices, and maybe most importantly, how we test what we think we know.
And the material we're drawing from it's from a pretty intense world. High stakes, systematic finance, and speculation.
And that's what makes it so fascinating. It acts as a kind of crucible. In capital markets, performance is brutally, undeniably quantifiable.
There's no hiding.
None. If your method doesn't work, you go broke, period. So the lessons we're pulling from Chapter 7 on decision-making and Chapter 8 on the scientific method, well, they're stress-tested. They're universal.
And what's so interesting is the central idea that comes out of all this. It kind of pushes against what you'd normally expect. We think complex problems, navigating markets or a business or even your career, they must need complex solutions.
Right. More data, more variables, more complexity.
But the core insight we found is the complete opposite. The most sophisticated, long-lasting successes, they're built on these astonishingly simple, disciplined frameworks.
A found strength in simplicity. But it's a hard-won simplicity achieved through really ruthless intellectual discipline.
So let's unpack that. Let's start with that core philosophical idea, Occam's razor. We hear the phrase all the time, but in this world of high-speed, high-stakes decisions, what does it mean in practice?
In practice, it mandates a reductionist approach. It forces you to strip things down. So when you're faced with competing theories or contradictory data or just too many strategies.
Which is always.
Occam's razor demands you choose the path that requires the fewest assumptions, the simplest explanation.
The source material has a great quote, if you can't explain it simply.
You don't understand it well enough. Exactly. In this view, complexity isn't a sign of intelligence. It's often just a smokescreen for confusion.
Okay, I want to push back on that just for a second, because in today's world, with big data, with AI, the temptation is always to add more, to build a bigger model.
It is.
Isn't resisting that instinct? I mean, isn't that incredibly difficult?
It's the hardest part. It truly is. The intellectual ego loves complexity. It feels like effort. It feels like you're doing something sophisticated.
It is like skill.
It feels like skill. But Occam's razor forces discipline. Let's take a market example. A trader is just bombarded with information, right? Interest rate forecasts, geopolitical news, earnings reports.
The noise is overwhelming.
Completely. Applying the razor here means ignoring 99% of that noise and focusing on the simplest, most aggregated signal you can find.
Which is price.
Which is price. Think about it. Price is the dollar-weighted collective opinion of every single market participant. It's one number that wraps up all the information, all the hope, all the fear.
So a systematic trader just cuts out all the punditry, the news.
All of it. They focus on that one clean signal. And that frugality, that simplicity, is what allows them to stay objective and focus on what actually moves the needle, the movement itself.
Okay, so that's the guiding philosophy, simplicity. Let's get into the mechanics of it, what the source material calls fast and frugal heuristics. These sound almost like a contradiction to the mechanical approach. What are they?
Well, they're not just random shortcuts. A heuristic is a simple but really powerful decision rule. It lets the mind take advantage of the way information is structured in the real world to get to a good enough decision very, very quickly.
So they're like high-efficiency mental processors.
That's a great way to put it. In any volatile environment, a battlefield, an emergency room, a trading floor, your ability to act fast with limited information often determines whether you survive.
So what you're saying is intuition isn't some kind of magic sixth sense.
No.
It's a skill you train by applying these simple rules over and over and over again.
Precisely. The material points out that people who make these kinds of high-stakes decisions for a living, pilots, surgeons, traders, they find that their trained intuition often beats slow, deliberate, rational analysis.
Why? Because the opportunity just vanishes.
It's fleeting. The window is tiny,
Yeah.
and your speed is critical for limiting risk. If you wait until you're 99% certain, the market has already moved against you. The moment is gone.
And that brings us to the two pillars of this, speed and frugality. Let's go a bit deeper on frugality. Why is using less data often better than using, all the data in the world?
It's because of analysis paralysis. Frugality minimizes that risk. The most effective systems, they rely on simple signals. Because those signals are robust, they're not fragile.
It goes back to that quote again. If you need 50 different indicators to tell you to buy.
You don't really trust any of them, do you? They're probably just noisy and canceling each other out. Many of the most successful systematic approaches just use price and time. That's it. Minimal data.
Can you give us an example of that in the real world?
Sure. Look at some of the legendary trend followers like Bill Dunn. When he first built his system, it was based almost exclusively on daily price data.
That's it. No economic forecasting.
Nothing. He was just looking for a significant trend defined purely by a percentage move in price from a recent high or low. It's an astonishingly simple idea.
No modeling of what the Fed was going to do?
No, just a mechanical response to momentum based on the absolute minimum amount of information. And that simplicity is what allowed the system to execute day in and day out without the fatal friction of human judgment trying to process a million conflicting data points.
Okay, so if this simple, systematic, frugal way of making decisions is so effective, why isn't it the default? Why do people resist it so much? And this leads us straight into the innovator's dilemma.
Yeah, the material points to this really fundamental psychological block. It's not just in trading, it's everywhere. It references the historical resistance to simple but game-changing ideas.
Like the number 0. Exactly. Or negative numbers. Intellectually, they're simple concepts, but they completely upended the established way of thinking. It took centuries for them to be widely accepted.
And the modern dilemma is the same. We resist a simple system that we know works.
It's identical. We have this deep, almost primal preference for what the material calls bold, assertive action.
We want to do something.
We want to do something. And the systematic approach often requires the exact opposite, passive reaction. Think about trend following. It demands immense patience. You have to wait for a trend to clearly establish itself before you react.
And that doesn't feel very heroic.
It doesn't feed the ego at all. We associate complexity and frantic activity, the image of the trader yelling on the phone, with skill and control.
So the impulse to add another layer of complexity, to always be tweaking the system, to intervene, it isn't really about getting better results.
No.
It's about feeling like you're in charge. It's about validating your own ego. Exactly right. The complex strategy is like a comfort blanket. If you lose, you can say, oh, there was a flaw in my model, the one that I personally built.
But if you adopt a simple mechanical rule, and that rule tells you to sell a stock you love or buy one you hate,
then you have to face the painful reality that a simple algorithm might have better judgment than your gut feeling. Simplicity demands intellectual humility.
And that is a huge obstacle for most people.
A huge obstacle. Complexity provides the illusion of control, even if it's systematically destroying your long-term returns.
Wow. That idea that simple systems are psychologically harder because they force humility, that's a critical takeaway.
Yeah.
Okay, so this conflict between our emotional need for control and the system's need for discipline, that sets the stage perfectly for the next part. Looking at decisions through this lens of process versus outcome. Let's start with the source material's really sharp contrast between discretionary or gut decisions and mechanical ones.
Yet the material it's completely uncompromising on this point. It talks about the idea of a multi-decade track record based purely on gut trading.
Yeah.
And it says it's 100% fantasy. It just doesn't happen. Not because people aren't smart, but because human psychology just cannot sustain that level of discipline over years and years of volatility.
That's a pretty devastating critique of the popular narrative, isn't it?
Yeah.
We love the story of the intuitive genius who just feels the market.
We do. But those stories are almost always a product of survivor bias. We hear about the one or two who got lucky for a while. We don't hear about the thousands who blew up their accounts because their gut told them to double down on a losing bet.
Whereas a mechanical system,
it eliminates that emotional vacillation. The rules for when you get in, when you get out, how much you risk, they're all quantified. They're programmed in. It forces discipline.
and the price for breaking those rules, for using your discretion.
The material says you are guaranteed to go broke. It's that stark.
So the system isn't really a tool to get rich quick. It's a tool for risk management.
It is the ultimate expression of discipline. When the system gives you a signal, you take it. It doesn't matter if you feel good about it or if you have a bad feeling in your stomach.
Because it executes.
You execute. That's why quantifying the process is so vital. It short-circuits all those behavioral biases, loss aversion, recency bias that are just hardwired into us.
Okay, so that brings us to the core tool for thinking about this long term, the process versus outcome matrix. It's this simple 2x2 grid, but it's so powerful because it separates the quality of your decision from dumb luck.
Absolutely. The matrix just asks two questions about any decision. Was the process, your methodology, your risk management, good or bad?
And was the outcome the actual result, good or bad?
Right. And you plot it on the grid.
Obviously, the dream quadrant is good process, good outcome.
Yes, but that's not the important one. The quadrant that really defines long-term success is good process, bad outcome.
Explain that. That's where most people get tripped up.
It is. A good process, bad outcome means you followed your rules perfectly. You managed your risk. You did everything right. But because of random chance, you still lost money. The sophisticated thinker, the successful systematic player, accepts that loss as just the cost of doing business. It's a necessary part of a sound system.
And the flip side is the most dangerous quadrant. Bad process, good outcome.
The absolute most dangerous. That's the impulsive, badly thought out bet that just happens to work out because you got lucky.
I think former Treasury Secretary Robert Rubin said something about this.
He did. He said a single decision can be terribly thought through and still be successful. And that success is so dangerous because it tricks you. It reinforces your bad process. You start to think you're a genius when really you were just lucky.
But over the long run?
Over the long run, repeatedly applying a good process will lead to better outcomes. It has to, statistically, even if some of those individual results are painful to live through.
And that pain is real. Accepting a loss when you did everything right, that has to be incredibly difficult emotionally.
It is. Which leads right into this idea of emotional feedback loops and the sunk cost trap.
The only way to decrease that emotional indecision is to quantify everything.
Exactly. The source material talks about the neurology behind this, referencing the neuroscientist Robert Sapolsky. He points out that humans are pretty unique in our ability to create stress just by thinking about things.
By imagining stressful situations.
That's right. An animal in the wild, say a zebra, experiences acute stress. A lion chases it. The threat is over. The stress goes away.
But we're different.
We are. We can take an ambiguous, ongoing situation like holding a losing stock or just general market volatility and turn it into this chronic, internal psychological stress. And that inability to resolve the ambiguity, it just paralyzes us.
And the system is designed to cut through that ambiguity. It gives you a clear, quantified exit point.
It forces the decision so you don't have to live in that stressful limbo.
And when that paralysis does set in, we fall right into the sunk cost trap. I think we've all been there, holding on to something, a stock, a project, way past its expiration date.
We have. And it's driven by cognitive dissonance. Instead of just taking the small loss, which the material calls the trend-following piece de resistance, and moving on.
We start doing mental gymnastics to justify the bad decision.
We do. We search for any kind of validation. I bought it at 100, now it's 50. I'm not using money. I'm buying it on a discount.
This desperate need to be right.
Yes.
Yes.
That need to be right prevents us from admitting we were wrong
and
taking that necessary small loss. And that turns a small, manageable loss into a catastrophic one.
It seems like the human ego is just mathematically incompatible with long-term success in complex systems.
That's the tragedy of it. The winners understand that this is a game of probability. Right and wrong on any single trade are totally irrelevant concepts. All that matters is the net outcome of the system over hundreds or thousands of trades.
But the average person is trapped by that loss aversion, that need to be right.
And it leads to that collective irrationality, the panic, buying at the top, selling at the bottom. A mechanical system is designed to pull you out of that psychological hellscape by just dictating your actions, regardless of how you feel about them.
Okay, so if we're successful in stripping away the gut feelings, the emotions, the biases, we need something to replace it. a framework that's robust and impartial.
Mm-hmm.
And the material argues there's really only one option, the scientific method, which is the focus of Chapter 8.
That's right. The scientific method is the ultimate foundation for critical thinking, for acquiring knowledge in any field, but especially in finance. It's a continuous cycle. You formulate a model, you test it, you refine it constantly.
There's a quote from David Harding, a pioneer in this space.
Yeah, he said he almost never bases a decision on his opinion. And if he does, it's an opinion about a mathematical phenomenon, a statistical distribution, not a gut feel about where the market is going.
So this implies that excellence requires this constant, rigorous test of reality. You have to ground every single theory in hard data.
It requires a kind of intellectual ruthlessness. Critical thinking means you have to ask the uncomfortable questions. The ones you suspect might prove your favorite theory wrong.
You have to actively avoid the self-serving questions.
You do. You have to avoid the questions that are just designed to reinforce what you already want to believe. And that rigor is deeply uncomfortable for most people.
The sources make this really interesting analogy between systematic trading and physics. They seem like totally different worlds. Why is that analogy so powerful?
Because both of them work off of models that describe observable relationships using the impartial language of math.
Okay.
Physics uses math to describe the relationship between, say, force, mass, and acceleration. Systematic trading uses math to describe the relationship between price momentum, volatility, and how much capital you should risk.
So they're both just systems of rules that you're constantly testing against what's actually happening in the real world.
Exactly. They require that solid grounding in numbers, because numbers don't have feelings, they don't lie, even when they tell you something you don't want to hear.
And the tools for testing these models are just as important. The source calls computer simulation a telescope for the mind.
It's a phenomenal analogy. Think about it. The telescope allowed us to see relationships in the cosmos that were totally invisible before.
Right.
Well, computer simulation does the same for data. It multiplies our analytical power. It lets us test millions of scenarios, backtest a strategy over decades of data, and find robust statistical relationships that the unaided human mind could never, ever hope to grasp. It moves decision-making from subjective guesswork to empirical evidence.
This brings us to a really fundamental point about the nature of reality itself, the difference between linear and nonlinear. We're often taught, especially in economics, to see the world as linear and predictable.
We are. Conventional capital market theory is built on that linear view. Rational actors, immediate adjustments to new information, and price movements that follow a nice, clean bell curve.
It's a comforting view.
It's very comforting. The problem is it's wrong. The reality is that the universe, markets, weather, biology, it's all fundamentally governed by chaos theory. It's nonlinear.
The world is volatile. It doesn't move in a straight line.
No, and trying to find a perfect predictive model is just futile.
We need to slow down here because this directly connects to the idea of a black swan event. What does nonlinearity really mean for how we should think about risk?
It's all about statistical expectations. If you assume returns follow a normal distribution, that classic bell curve.
You believe extreme events are almost impossible.
Right. A 20 standard deviation event under that naive assumption is something that should basically never happen in the entire history of the universe.
But they do happen.
They do. And the source makes this critical point. These so-called black swan events are only 20 standard deviations if you naively believe returns are normally distributed. They're not.
Because markets have what the material calls fat tails, or high kurtosis. Can you explain that in simple terms?
Sure. Kurtosis just measures the tailedness of a distribution. High kurtosis means you have a sharper peak in the middle, so more average, boring days.
Right.
But crucially, you also have much heavier or fatter tails. And those fat tails mean that the extreme events, the crashes, the huge rallies, they happen far, far more often than a standard bell curve would ever predict.
So when a big financial crisis hits and everyone on the news is shouting, this was a 1 in a million event,
the systematic thinker knows that, statistically speaking, it was probably a 1 in 10 or 1 in 20 year event, and that any risk model that didn't account for it was simply built on a flawed, linear view of the world.
Exactly. Lasse Pedersen's research looking at 800 years of data showed the world is clearly non-normal.
And this is where systematic trend following thrives. It doesn't try to predict the nonlinearity. It just accepts that volatility is inherent and prepares for it with robust risk management. Volatility isn't the enemy.
It's the source of the trend.
Which is the source of the profit.
So If we accept this nonlinear world and we use the scientific method to navigate it, the ultimate reward for all that discipline is compounding. The material really hammers this home. Compounding isn't just a math concept, it's a discipline.
It's the engine of all long-term wealth, but it requires radical, almost painful discipline. If you don't compound your profits, if you take them off the table too early or let a drawdown eat away at your capital base, you're just leaving money on the table.
So for these systematic firms, it's a core philosophy.
Absolutely. Compounding absolute returns means you have to have the discipline to ride out the inevitable losses, because you know that the few huge winners are what pay for all the small, necessary losers the system generates along the way.
But compounding is a double-edged sword. It creates this intense pressure to bet more, to over-leverage.
Yeah.
How does the scientific method control that risk?
It uses a very specific and crucial tool, the Kelly formula.
Okay, let's break this down.
The Kelly formula is basically a mathematical framework for optimizing your bet size. It takes your probability of winning and the ratio of your potential win to your potential loss.
And it spits out the optimal fraction of your capital that you should risk on any single position.
That's it. It finds the mathematical sweet spot.
And in doing so, it defines these two fundamental rules of risk management. Let's start with the first one, the timid trader rule.
The timid trader rule is simple.
Mm-hmm.
If you bet too little, you're never going to make very much. Your returns will be tiny, you're being too safe, and you're sacrificing all that potential compounded growth.
You're safe, but you're not going to be successful.
Right. And then you have the opposite, which is what leads to those spectacular flameouts we always hear about. The bold trader rule.
If you bet too much.
If you bet too much, if you go past what the Kelly criterion suggests, you are mathematically guaranteed to go broke over the long run. It's not a question of if, but when. The volatility of the larger bet size will ensure that a normal string of losses eventually wipes you out.
So the Kelly formula finds that perfect line right on the edge, maximizing your growth rate while minimizing your chance of ruin.
Exactly. And to manage this across a whole portfolio of different trades, they use a concept called portfolio heat.
It's like a risk thermostat for the whole system.
That's a perfect analogy. It measures the total risk you're carrying across all your positions at once. This ensures that no matter how many trades you have on, your aggregate risk stays within these scientifically defined limits.
So it's a practical application of the bold trader rule across the whole operation.
It is. Most funds will cap their risk so that the absolute maximum they could lose on any one position is a small fraction of their total assets, maybe 5%. It keeps them in the game.
And once again, it all comes back to discipline. The courage to bet enough when the system says to, but the discipline to stop, especially when you're in a painful drawdown.
You have to understand that the drawdowns are part of the process. They're inevitable. The system is designed to take lots of small losses while it waits for those few massive winners. And the discipline is trusting the math through that pain, knowing the big wins are coming.
Okay, we've covered a lot of ground here. From the philosophy of Occam's razor all the way to the math of the Kelly formula. If we pull all of this together, what's the single core finding about systematic decision-making versus, discretionary genius?
The evidence is pretty overwhelming, especially where performance can be quantified. Systematic, data-driven approaches are just superior.
It's not about being the smartest person in the room.
It has very little to do with raw intelligence. It's almost entirely about emotional makeup, rigorous testing, and iron-willed discipline. The system's main job is to remove the human fallibility that we all have.
And we often put these geniuses on a pedestal, but the source material reminds us that even the legends are subject to volatility.
That data is so important for perspective. I mean, you look at someone like Warren Buffett, who is universally revered. His vehicle, Berkshire Hathaway, has had drawdowns of 51% and 49% just since 1980. That's a brutal amount of volatility. It shows that no one is immune to losses.
But the difference is in the recovery.
That's the key. Buffett succeeded because he stuck rigorously to his system value investing, and he recovered. It's the same with systematic trend followers. They might experience a huge drawdown, like Dunn Capital did in 2007.
I think it was 57%.
57% loss. But they recovered and made new highs because they never abandoned their core quantified concepts. Their faith wasn't in their personal ability to call the bottom. It was in the long-term statistical validity of their process.
So whether you're betting on value like Buffett or momentum like Dunn, the key is trusting the system through the inevitable pain.
That's it.
And this really is a universal strategy, isn't it?
The sources make a strong case that it is. These principles, simplicity, risk management, reacting instead of predicting, they've worked across completely different markets. Currencies, commodities, bonds, you name it.
And across different time periods.
Across centuries. Some of these studies go back 800 years.
Why is it so resilient?
Because it's not exploiting some temporary glitch in the market. It's exploiting stable, predictable human reactions to uncertainty.
Fear and greed.
Fear and greed. They are remarkably constant over time, and they create these collective panics and euphorias that result in long, discernible trends. A robust, risk-managed system can just harvest those trends no matter what asset is moving.
It all comes down to accepting you don't need to predict the future.
You just need a disciplined way to react to the reality that's unfolding right in front of you.
The moment you give up the need for prediction, you gain the power of process.
You know, we've really dissected how to build a decision framework that uses the power of simplicity and the rigor of the scientific method. But the end goal here isn't just some complex trading strategy. It's a state of mind. Success, at the end of the day, doesn't come from having perfect, complicated answers. It comes from having the intellectual humility to know that your models aren't perfect and that randomness is always going to be part of the game.
It makes me think of that amazing quote from the physicist Richard Feynman. He said, "It is much more interesting to live not knowing than to have answers that might be wrong."
That's beautiful.
And that's really the path, isn't it? To be successful in this nonlinear world, you don't need to predict the next step. You just need to adopt a robust system that lets you manage the consequences of your own uncertainty.
When you strip away the emotion, the ego, that desperate human need to be right all the time, what's left is just pure system and discipline. And the data shows that's the only thing that works consistently in a chaotic world.
So we'll leave you with this final provocative thought. How often in your own decision-making do you consciously choose simplicity, quantified discipline, and an acceptance of random outcomes over that comfortable, ego-boosting illusion of being the subjective genius who's always right?
Because that choice is everything.
The material suggests it's the ultimate difference between success and failure in any complex endeavor.